There's only one thing stopping you from achieving your investment goals. It's not what you think, it's not your oppressive student loans or the country you live in, or even the Federal Reserve that keeps pushing your portfolio down with rate hikes. No, the one thing that's stopping you from unlocking your true potential is your own mind. I'm not going to quote Morpheus on you and say that anything is possible if you truly believe, and that you have to tap your ruby heels together 3 times to make it possible, but there are very real psychological barriers and traps when it comes to investing, and pretty much all of us struggle with them. But there is a way to overcome these barriers, to break them down one by one and truly unlock your investment potential. I'm not saying that it's going to be easy, but it is definitely possible. I'm going to show you how to do that in this video. From understanding the way that you think and in turn how the market thinks, to avoiding all of those insidious pitfalls of reasoning that trap and paralyze us, preventing us from making smart financial decisions. Some of the greatest achievements in human history were gained by people quite literally forging their minds and mindset into who they needed to be to succeed. Athletes had to believe that they could achieve what was currently impossible. Engineers had to think outside of the box and imagine systems that people told them wouldn't work. I'm sure the Wright brothers were under a lot of mental pressure when they told people they were going to build a machine that could fly. What was different about these people that allowed them to defy all odds, pushing forward when everything told them to hold back? And how do you gain the same mindset and use it to dominate the uncertainty of the markets? Investing is no different to any other forefront of thought, and people have believed in mantras that have sunk entire companies and nations. Even today, you'll find countless experts arguing amongst themselves over the basic tenets of finance and investing. Up until a few months ago, anyone saying FANG stocks were overpriced would be ridiculed, told that they have nowhere to go but up in a tech-focused future. Some of these companies are down more than 50% today. Mastering your own mind to maximize your gains means understanding how your mind works, even on a subconscious and natural survival level, and extrapolating out that understanding to the broader markets as a whole. It's important to comprehend what makes people invest in the ways that they do, how the markets move together and against one another. If I say to you that I think the market is undervalued right now, and it's surely going to go up, would you believe me? What if later you overhear a conversation saying something similar, and then your hairdresser mentions how he's going to be investing soon and the prices are so cheap? Even if this was the case, and you and I both knew at the time the market was relatively high and could drop considerably more due to underlying fundamentals, would you listen to that voice in the back of your mind? The one that's telling you, everyone's buying, I should buy before it's too late. At this point, I think everyone knows that sentiment and emotion guide stock prices more than fundamentals or any kind of real logic. I mean, of course it's there, you can still find perfectly valued companies and assets where the math adds up, but when the chart of an indebted, obsolete gaming retailer looks like a mountain range, and you have an entire generation of investors YOLOing their life savings into same-day expiry calls, something else might be at play. We are human after all. Even if GME holders do call themselves apes and crypto investors call themselves degens, we're drawn to intrigue and hype. Nobody wants to be sitting by themselves in the corner missing out of the party while everyone else is having a good time and getting rich. And yes, I did just call investing a great big party because it really is. The big cats are invited to nice fancy meetings with champagne and perhaps a side of insider information, while the platforms act like the bouncers telling everyone to keep the noise down and to stop banging on the door. We gravitate towards what's interesting or trending or popular. ESG scores are an incredibly popular method of investing these days with a younger, environmentally and socially conscious generation of investors. But a lot of the time, these companies don't have financial success, or their desire to hit the ESG targets come at a cost to their bottom line. In these cases, investors are making the irrational decision that because what they're investing in is morally good, according to them at least, that they'll be rewarded by being on the correct side. Because surely those evil oil companies destroying the planet will get what's coming to them, right? Well, that's not always the case, and if the world worked purely by morals and fundamentals, we'd be living in a very different world indeed. I do believe that with time, as investors and speculators become more self-aware and sophisticated, we could potentially see a shift towards the morally good, which is one of the reasons why my Web3 brand, Bloom, is pursuing the environmentally sustainable narrative, and which is why we chose to launch only after Ethereum switched to proof of stake and became 99.9% more energy efficient. This, along with the idea of having a highly limited supply of physical products and rather expanding our reach digitally, is how we aim to grow the brand without having an outsized negative impact on the environment. I'll cover this more in the future, but for now, there's a link down below in the description if you want to check it out. So how do you identify the sentiment of the market and work out if you're investing in a bull run or a bull trap? Are you caught up in the hype or joining the broader pessimism and missing out on a potential payday? Be greedy when others are fearful. fearful, and fearful when others are greedy. This is one of the most iconic investing quotes that I'm sure you've all heard before, but for some reason, people still don't really pay attention to it. And the problem with that is that these people are getting sucked up into the despair and the hype of the markets, allowing it to affect their judgment and ruin their trades. Greed isn't necessarily bad, and a healthy dose of fear is always a good way to bring yourself back into the real world. Nothing jolts you back into reality quite like an immediate market dump right after you throw your life savings into a speculative bet. But how can we use these emotions to help keep our trading in line and on target? Well, there are a few ways. Some are based on outward consensus and the heartbeat of the market, but the important ones are introspective. Self-analysis and the ability to take a step back and really question whether you're acting rationally is an incredibly valuable trait to have, and is a trait that can be learned. Outwardly, the market is always in a constant ebb and flow. You're never going to be able to pin down the precise sentiment, but you can get pretty close to it. The easy way, and one that I personally avoid, is to watch mainstream media and see what sort of talking points are repeated throughout the cycles. Who is ridiculed, who is praised, and are the bears proudly parading around feeling vindicated, or are they being the punching bags of the bulls? The media is a reflection of public sentiment. As sad as that is, it's the truth. They might not give the most accurate news, but they usually match the energy of the market in order to gain the like-minded audience, and in some cases, more often than not, to even influence them. Taking the inverse approach, or at the very least having an objective view of it, is a good baseline to have, because getting caught up with the crowd in being overly optimistic or failing to find value when it presents itself are equally detrimental. To master our internal biases, we need to look at how greed and success affect the way we think. To master this is to really take the emotion out of trading altogether. There are few things in life more satisfying than seeing your investments skyrocket. I'm sure you felt it too, that rush as you watch your balance rise, every second that little bar making you more and more money. It's invigorating, it's addictive. The satisfaction of making the right choice and then reaping the benefits resonates in your mind, confirming your own bias, that you did, in fact, outsmart the market. Maybe you can do it again. Maybe it'll keep going up. You were right about the investment and it's already gone up 5 times. How much better would it be if you 10x'd your money? Confirmation bias is one of the most dangerous, reaffirming psychological effects when investing, and I can't even begin to describe how many people have lost everything because they saw some gains and they assumed they'd cracked the code. Believe me, there are ways to game the system and invest intelligently, but there's a big difference between calculated and objective strategy versus assuming the rally will never end because you're part of it. Or worse, when you've genuinely made a trade that nobody else saw coming, and because of that, suddenly you feel invincible. Every trade you make is going to be a winner, and then next week, with all your newfound confidence, you lose everything you made and more. You're back to square one, or worse. The simple way to avoid this is to clearly set your goals and take profits. If your plan aims for a 15% return or a 100% return, once you get there, reassess the situation and lock in those gains. The downfall of almost all investors doomed to eventual bankruptcy is to overreach. Nobody ever got poor taking profits, but there are plenty who did, going that extra mile for just 1% more. For every gain, there's the potential for an equal or even more painful loss. Humans have evolved to avoid pain at all costs, and we do some pretty crazy things to escape situations that discomfort us. Investing is one of those things, and investing while trying to avoid pain is entirely a recipe for failure. Investing is inherently risky. You're taking your blood, sweat, and tears, maybe even money that you earn from a 9-to-5 that you absolutely hate, and putting it at risk. In the end, you could lose it all, and all that time would have been for nothing. This fear can be paralyzing, and it's a serious factor when it comes to every investor, and that's loss aversion. Tolerance for losses is so much lower than the expectance of gains, and that in itself is illogical. Over time, markets will generally rise, but in the average year, at best, you're only going to get a few percent. You have a slightly above average chance to make money in every individual year, but it's when you take consecutive years in a series that gains become near guaranteed. You should absolutely expect losses. It's part of the economic cycle and a fundamental part of finding value in the market. There's only one true way to train your mind to stomach a loss, like any other loss you may experience in life. It's a part of life. It's going to happen sooner or later, and no matter what you try and do to avoid it, to your own detriment even, it will always catch up to you. Understand that loss isn't a failure. Trust me, I know it's hard to see your portfolio in the red and dropping every day. I've been there, we've all been there. Right now, most of us are there. Even Warren Buffett, the greatest investor of all time, has his red days. No matter how long the rally is, there are going to be consecutive periods of loss, and in bear markets, these losses can continue for months and sometimes even years. So how do you look at your bleeding portfolio and resist the screaming urge to sell everything and YOLO into whatever is trending at the time? What makes the prospect of further potential potential losses by staying in the market better than selling everything and trying to buy in lower. There's a few ways you can remind and reassure yourself that you're on the right track, even if you're down in the red. The undeniable fact is that the markets are always swinging wildly above and below their fair value, and both of those situations are amazing opportunities. Maybe you bought a bit too early and tried to catch the falling knife but missed. I would assume you bought in for a reason, right? The price you bought at earlier made sense at the time, whether it was properties, stocks, or crypto. It doesn't matter what your investments are. You hopefully did your research. You identified a gap in the market and put your capital to work. You should be proud of that. You should own it. If the price dropped more, so what? You've been offered an even better price for something that you were willing to pay more for just a little while ago. Think about that. Your original investment may be down, but that capital is still working at a price you deemed cheap at the time, and you're still expecting profit in the future. Of course, I'm not saying hodl until your bags go to zero or until you get liquidated. This falls into the territory of investment fallacies. The idea is your investment was originally sound, and maybe public perception is a bit more negative than you thought, or something unexpected happened which pushed the market down overall. Whatever it is, it shouldn't affect the fundamentals of your decision, and if it does, your original decision was wrong. At that point, by all means, reassess the situation and decide on whether you've made a big mistake and need to change your original plan. In chasing success, you need to have an objective mindset. What you need to do is simple. You have to hack your mind, just rewire it, rewire the way that you think. It's pretty easy, right? Well, kind of. It really is all in your mind, and you just need to objectively filter out your own fears and biases. To do this, one of my favorite quotes comes to mind. Your mindset is the lens through which you see the world. If you've got a broken lens or it's misaligned, it's going to affect your perception and how you see future decisions. The clearer your mindset, the more clearly you set your targets, avoid obstacles, and move correctly towards your goals. If you spend your whole life looking through your lens instead of taking it off once in a while and expecting it, you'll never find out whether it's faulty or not. Just like I did with these glasses before this video started. But how do you identify a fault or even fix it? This is obviously the most difficult aspect of introspection, and of course I have my own personal biases that I still struggle with sometimes. But then again, if this was easy, then everyone would do it, and maybe the markets would make a bit more sense at that point. But they don't. I found that one of the best ways to self-assess is to look for the things you have a visceral negative reaction to. For example, if you've always laughed at the idea of investing in bonds, they give a below market rate, so why would you ever invest in them? Well, here's the thing. For investors with large amounts of capital or extremely long time horizons, bonds can be a pretty effective way of holding a constant return, regardless of market conditions. Maybe you don't need the capital returns of a growing equity market, but you need a consistent yield in retirement. Dismissing bonds on principle would be one aspect of a murky lens and would likely lead to a skewed perception of other investment types. Try it out, clean your lens, and let me know down in the comments below which type of investment you personally don't understand why people hold, and I'll try my best to give you an alternative answer in the replies of those comments. Now, in addition to whatever your personal biases are, everyone also has their own risk tolerance. Now, mine is relatively high because I've learned to take responsibility for every single decision I make, and yours could be higher or lower. Totally depends on its personal preference. Now, could your risk tolerance lead to higher gains or more losses? Possibly, but in the end, it's not even about whether you're more or less risk averse. What matters is getting an understanding of your own mindset and then comparing it to others. The big picture is that by doing this for every aspect of trade, investment, and mindset, you can get a good impression of where you stand in comparison to everyone else. And from there, where you stand against the market, whether you align with it or you contrast it. This is incredibly valuable information that can be used to reassess how you view your investments and why you even make them. Instead of being the guy who thought that Dogecoin was going to $100, or that their 10x leveraged FANG portfolio could never fall, or even that the stock prices in 2014 were just way too high and then you missed the bull run, you can be the person that takes the profit, cuts the miscalculated loss, holds through the economic downturns, or even rides the bull run to its peak to take the killer of all profits. There are a number of incredibly stubborn pitfalls that catch even the most sophisticated investors off guard, and you want to pay close attention to these or risk losing everything you worked so hard for. Human nature is complicated, and in every part of our lives, our mind plays tricks on us, or we convince ourselves of certain things as a way to cope with pain or loss. This doesn't just apply to your relationships or your job, but also to your investments. And building an investment on a fallacy is a great way to lose money. There are a few of these, and some scarily familiar to how we approach other aspects of our lives. Identifying and avoiding them will not only help you achieve excellence in your investments, but also excellence in your own life. For example, the 4-year relationship that you might have ended a year ago, but you're both pushing on because you guys have spent so much time together already. And if you break up now, it would be a waste, right? Well, this is the same thinking as holding onto a losing investment that's costing you more and more each day, the sunken cost fallacy. And it's a dangerous one and can lead you to missing out on far more than you would lose by simply making a decision to cut ties. Yes, the company you invested in might have reshuffled their entire executive team and dropped 70% because they were losing market share to all of their competitors, but you've already lost 70%. So what's another 30% for the chance that they turn things around and make back all of your money? The likelihood is that unless there is some real data and action to back that assumption, you're simply justifying a bad investment. And it's not just costing you what's left, it's costing you the opportunity to invest that into something better while you're waiting for your balance to hit zero. It's a remarkably similar trap to an equally dangerous situation, and that's the fear of missing out. FOMO. I've mentioned it earlier, but this is truly one of the worst mindsets to have in any form of investment. I've lost count of the number of times I've seen people FOMO into the peak after everyone's already made their money and cashed out. It's human nature at its finest. It appears as though everyone around you has made the right decision and you're sitting there with an underperforming portfolio, at least compared to theirs, right? Sure, everyone might be up 30% this year, but your friend Chadwick, he made 30% last week. The thing to remember is that usually by the time you actually feel like you're missing out, well, you already have. The train has left the station and jumping on the track after it's going is going to get you run over. If you still aren't convinced of the power of mind over matter, some of the wealthiest and most successful investors and businessmen have this exact same mindset and use active focus to detach their emotions from their decision making. And the results speak for themselves. As I've said before, Warren Buffett is one of the classic examples of truly ignoring market emotion, choosing to remove himself from the chaos and influence of Wall Street and instead conducting his business in Nebraska, allowing him to clearly think about his investments with a broader horizon. At a net worth of over $90 billion made purely from long-term investments, he's quite literally the most successful investor in history. Roaring Kitty, another famous investor, but one from a completely different paradigm, made famous for buying out the money calls on GME, a trade that everyone thought he was insane for making, he demonstrated his unwavering stoicism. He knew that his fundamentals were right. He'd done the research, and even with the entire world telling him to give up while he was losing money, he stuck with it until the inevitable came to pass. Despite his trade sinking into negative territory for over a year, he knew it was just a matter of time until it paid off. And it did, bagging him $50 million from only a $50,000 investment. With all of that quite literally in mind, overcoming the challenges that we face every day in our lives, not just through investment, should be achievable. But as this video has shown, in the end, it comes down to your own personal determination and how much you want it. You have to mold your mind into truly believing success is something you need for survival. Because when you want to succeed as much as you want to breathe, nothing can stop you. With your mind sharpened and ready to think outside the box, check out this video on how to actually time the market. If you made it all the way to the end of this video, comment down below. The mind is malleable. I shall see you in the next video. Cheers.